should be a decent environment for bonds, especially if you had the longer term bonds that had a locked in a higher interest rate, because now those bonds are becoming more valuable as rates drop. I mean, we generally saw this in the 80s through the 2000s because we had interest rates up in the 12s, right? So you had bonds that were giving you 10-12% rate of return. So those bonds look great when you're only getting 5. We don't have that same delta now, but we are going to see the price return along with the coupon payment that you're getting with the bonds. So at least in the short term, this should be a decent environment for bonds because, like I said, a dropping interest rate environment should be good for the value of those bonds.
Yeah, absolutely. And I think something to remember too, sort of about what the Fed is doing and how this impacts everything in general, is that while we are using, right, the Fed is using past data to make current decisions, current sort of market situations are not the same as what the past data is sort of showing.
Right.
So that's one of the really hard things for the Fed. And people are like, oh, Jerome Powell and the Fed messed it up over the last couple of years. They are always in a new situation, right?
Yeah.
Whatever the economy looks like right now, the economy has never looked like this before. And it doesn't matter if we've been in a recession, not a recession, it doesn't matter. There is some part of that scenario that is new, and they are guessing a little bit.
Yeah, you're predicting the future at the end of the day.
Yeah.
Right. So, and that's why you really don't want to pay attention to like, well, this is the average that happened when, the Fed rate cut happened, because I've seen 100 charts come through the last few weeks about like, this is what happened on a typical rate cut. Like, yeah, but the environment of the economy mattered much more than the average.
Much more.